Ed Bugos here. Most of you know me as Jeff's partner and the co-founder at the Dollar Vigilante newsletter. You know, the Dollar Vigilante has been one of the fastest growing financial newsletters on the web for many reasons. And my track record obviously plays no small part. But it is up against the wall right now on a year-old bear market call. If you don't read me regularly, you might think I'm always bearish on stocks, but in reality, I'm just a little bit less bullish on stocks than most other things right now. But sometimes I'm very bearish on stocks, and this is one of those times I've been very bearish on stocks. As far as investing goes, though, we care most about gold, silver, crypto, and mining stocks. The dollar and the stock market are sort of incidental to our strategy, if you will, but they're part of the story. If all were fine in the dollar world, we might be buying other kinds of things, industrial tech shares, regular businesses. But the investment case for gold and crypto is the dollar collapse story. Inherent in this story, though, is an inflationary central bank, but the central bank stopped inflating 2.5 years ago. It stopped inflating really for the first time in decades and for the longest stretch now. If it were to continue the current policy, it would slow the dollar's collapse. Think about what I just said. But in turn, not just gold and crypto, the whole of the US financial system is built on cheap money too. And money is no longer cheap. Of course, everyone knows, it's just a matter of time before they find a reason to reflate, to pivot. But until they find that reason, the dollar collapse story and the stock market bull, they're both at risk, I believe. So some analysts believe the rate cuts now, in both cases, signal the Fed's new cheap money policy, or it's coming, or it's a eventuality. But I think that reveals a psychology that refuses to accept the reality of the previous deflation policy. Right now, the central bank it's not trying to inflate, and it's been successful in keeping this paper asset boom going despite all odds. But nevertheless, the anti-dollar trade, one we're concerned with, rests on a central bank desperately trying to inflate in order to keep the government and its insolvent banking system alive. But with stocks rising and the price inflation falling, the need for the Fed to step on the gas isn't there. So one of two things must happen for this to change. The bond market either one disagrees with the Fed about interest rates because the government is borrowing so much that it's not able to push interest rates down, at least in the long-term market, as much as people expect. And two, which is really an and or, because that would probably upset the stock market too. But number two is the stock market bubble pops. And it pops just because it doesn't have the requisite fresh money that it's been conditioned to ride for the last 15 years. But so far, neither of those things have happened. And so in a way, it's a standoff. It's a standoff between dollar bulls betting that the economic boom is sound enough that the Fed doesn't need to reflate, and dollar bears betting that the Fed has already started to reflate. So we're with the bears, of course, eventually, but because we don't see the Fed turning over a new leaf and starting a sound money policy, for example. But many of dollar bears, many of the gold bulls, many of the crypto bulls, they've all been to one extent or another in denial about the previous deflation policy. So if the stock markets have priced in an easy Fed, so is gold. we could say that gold is also benefiting from a geopolitical safe haven demand. You could also say that gold bugs are ahead of the curve and betting on the financial crisis as I am right now. But many gold bugs have been betting on rate cuts, and the media has been very consistent about explaining everything that goes up in terms of the coming rate cuts. So we continue to bet that the financial bust is ahead here, and it's going to occur long before the investing public gives up on the idea that the governments and the banks have done away with inflation. Okay? So the following is a recording of an informal discussion between Mike Benke and I about all this. It's informal, but we're going to share it anyways because we think there are a few nuggets worth considering in it. Mike is a brilliant and multi-talented securities analyst that works for us, and you're going to definitely hear more about him in the future. I couldn't do half of the work that I do without him right now. In this case, I'm asking Mike to be critical of my bear market call. So please enjoy. Over and out. But my point is, or my argument is that this boom inevitably will end because it's so malinvested. It's got so much capital and labor invested in unproductive areas, and there's so many imbalances, so many historical extremes, so many delusions that drive some of these trends that it's difficult to see how it can continue. Let's put it that way.
Well, to be honest, I watched your presentation at Anarchapulco this year, and you at the time you made very compelling arguments on all of the stuff you just said, and honestly, I agree with all these points. It seems like we're right on the cusp, right? But I feel like we've been on the cusp for an extended period of time, and the nagging thought in the back of my head is, well, if we didn't expect it to extend this long, who's to say it couldn't extend another year or another two? Maybe the deflationary effects are coming. You're right, they are coming. But to give the Fed credit, they've managed expectations so well to this point that they can continue to extend that lag between tightening and the inevitable bust. Maybe by another year or two. Like, is that? I guess if I was going to question you on something specifically, it is on the timing, and we haven't been right about the timing. And is there anything that we've learned in that, or is it just giving you more conviction that it's around the corner, or can this extend just on psychology for another year?
No, I don't think it can extend it much further, not a year or two, but what we have learned, definitely, we've learned some things. We've learned we learned that the market can stay up longer than people expect, of course, right?
Yeah.
This is an axiom that I knew full well in terms of timing. But the timing to me is only sort of a secondary thing. I mean, look, the main thing, our main investments, 80 80% of our portfolio, our investment allocation is the anti-dollar trade, right? So
Mhm.
gold, silver, and crypto, and the gold and silver miners,
Right.
for example. Okay, this is most of our portfolio,
Which is all done well this year
right? But what I care about,
in a deflationary environment.
right, and so timing this cycle, the only importance it has for me is that it's going to, when Wall Street panics, what happens to everything. I mean, we saw what happened to the panic of 2020 in oil markets. They went, a commodity that is hard as intangible as can be, and that's as needed as can be, went to
Yeah.
almost zero, right?
So quickly
We
too. So quickly.
right. We've seen irrational moves like that even in previous liquidations. The 2008 liquidation. I mean, you saw that liquidation take out some of the biggest banks in the world. Citi bank, for example.
Well, no,
The
I'm glad you mentioned that because, I know there's a lot of things different about then and now, but there's also some similarities. And, you know, wasn't it in 2007 that the Fed pivoted and started cutting rates? And yet
yeah,
it took nearly a year before, things fell apart. And I'm
yeah.
like, could we not be dealing with the same kind of timelines now?
Yes, except the rate hikes back then were done over a 3 or 4 year period at 25 basis points every meeting, forecasted, telegraphed, never deviated from, and did not include any money supply deflation, right?
Right. Those are some
So,
big differences. Yeah, for sure.
so in this case, it was a very drastic increase from zero up to 5% in a very short period of time, and it created a deflation shock in money and credit to a patient that's become accustomed to living off of fresh liquidity,
Yeah.
right? So that's where and we got our 2022 correction, right? And so you asked what we learned, and like, did we learn why we were wrong? Yes, we learned why we were wrong. We underestimated the Fed's ability to pump smoke up your ass. What it was doing all year long, right, Mike, was it was telling people that it's going to cut rates. And what was happening all year long in response to that was rates were coming down in the real markets,
Yeah.
right?
Yeah.
So the rate cuts were effectively happening in
Exactly. Yeah.
most interest rate markets, right?
Leading the
And
Fed, ahead of the Fed.
right, and that's what was driving stocks higher. And kudos to the Fed for that. The Fed took big balls for the Fed to start deflating money, right? That because if you were a Fed guy, if you were in the Fed at the time and you knew that would your monetary policy would have that deflationary impact on money and credit,
Mhm.
you would have expected a collapse.
Well, I think what they're aiming for was a soft landing, no?
Well, but you wouldn't have expected that. You would have, if you knew anything, I'm sorry, if you knew anything about Austrian theory, and I suspect that some of them pretend they don't, but they know. They know that they know enough to know that if you take a lot of liquidity out of the markets, it's going to collapse the market, right? You know that because if you talk to the average stockbroker and you say, well, let's just end the central bank, they go, well, we need something to keep the markets, going. Otherwise, the markets will collapse without a
Exactly.
central bank,
Right.
right? Okay. Well, that's the same thing. The central bank stops printing, it stops intervening. It's like not having a central bank. Markets didn't collapse, right? Um, but they should have. History says they should have. The central bankers, some of them should have thought that it should have, but they knew that if they didn't do what they were doing at that time, if they
Mhm.
didn't embark on those rate hikes, they didn't have a time to think about it because the bond market was falling apart. The treasury market was falling apart because the CPI was inching up to 10% year over year. Remember?
Yeah.
I remember how fast that happened from 2020 when it was just, uh, all party. Then 2021, you had inflation rates up at 3 or 4 decade highs all of a sudden,
Oh
right?
yeah. No, no,
And they were like,
they were forced to act. For sure they
right.
were forced to act.
And they still acted slowly, right? They still took a long time to, but I think there's a lot of time between when they said they're going to start to act and the CPI started to go from 5% to 9% or whatever, right?
Mhm.
But the point is that they were forced to act, yes, and their action prevented it from getting worse, right? And I think that it probably surprises them just as much as anybody else that nothing came of it, except for the mini bank crisis, which they were able to um,
STEM.
catch,
Yeah.
right? Yeah, stem, catch, or whatever, with a little bit of liquidity and a lot of rate cut promises. So the whole year, we've seen rate cuts drive the market higher, but these rate cuts were rewards to the Fed for being able to actually pull the rug out from underneath the thing that was causing price inflation.
Right.
Okay? So the market was rewarding the Fed for that. and is rewarding the Fed for that. So that's why I say kudos to the Fed. It beat us there on one turn.
But
But the
let me
problem,
just dig in. You're saying that you think that some people at the Fed, must know Austrian economics, must realize, what's going on, and that's why they were acted. The counter argument is that they believe their own BS and they really believe that they can land the plane softly. And so I guess where I'm a little hung up is if there is indeed somebody at the Fed that knows they can't land the plane, what are they hoping to achieve by, making it seem like they're going to do a soft landing? Like, what's the goal there?
well, I think that's where the Earth's become a psyop. I think at first it wasn't like they planned this whole thing all along. I think at first they were literally forced into action
Right?
to save the bond market. And then they found out, oh, things did not collapse. Oh, but we got this bank crisis. Things are collapsing. Let's do something about it. Um, and then they shifted to the idea um, of promising rate cuts. And then
Yeah.
still, they noticed because the effective rate cuts were supporting this rally, even though guys like Bugos were saying sell, 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 they saw that the rally continued. So that emboldened them, I think, and they were like, well, maybe we're not going to get a collapse after all. Maybe we are going to get that soft landing that we get sometimes, right? Um, so, I could see them trying to rationalize the comparison to 1994 or 1995, but there's no comparison. I mean, 94, 95 had no such ridiculous valuations or distortions,
So
you know.
what would you say to a central banker that came up to you and is like, maybe agreed with everything you just said so far, but it was like, yeah, it was a tricky maneuver, it was a tricky situation. We weren't sure if we were going to come unscathed, but you know what? We fucking pulled it off. We landed the plane. Inflation's within target. It's no recession. Uh, the rates are coming down. GDP looks good. So what would you say to that central bank? Are they confused? Are they
No,
too much
say,
confidence?
well, I would just say, well, look, there's no way for you to really get the plane off the ground anymore. When you've pushed interest rates down to zero and keep them there for a decade, the metrics that you use to value things are not there, right? I mean, the standard net present value calculation you see everywhere is NPV 5. It's been NPV 5 for 2 or 3 decades as if there's been no change in interest rates,
Good
right?
point. Yeah, good point.
Nobody wants to go to NPV 0. I mean, they do in the royalties market, they actually do go to NPV 0 in some cases.
Well,
But
so let's say the Fed has no real intention to go down to those ultra low interest rates anytime soon or ever again. And let's also assume that the market does believe that.
well,
Um,
I think just to interrupt you, Mike, I think the Fed can't do that right now anymore because the economy is too fully loaded. It would create the same inflation problem instantly.
right.
So, in the
So I guess I'm saying why can't they just take a step back? You mentioned that the Fed didn't need to print any money to lower the interest rates by 50 basis points just recently. That the market was yields were in the real market were already going lower. So why can't the Fed just kind of stay out of the way right now? It's just and just let it be.
sure, it can. It
Like
can.
what's I guess
What I'm saying is that the market still doesn't have that fresh liquidity to make new highs and continue on.
does it need to make new highs? And is
Well,
it
if
is the Fed's goal to keep the stock market inflated? Because I've often wondered. And I think we even discussed it almost seemed like the unrelenting stock market bull is problematic to the Fed's goals as well.
well, I have two answers to that because there's two questions in there. And the first answer is yes, it has to make new highs if if you're in stocks, you want positive returns, right? So you want if you're in stocks and they're not giving you the return for the risk that you're taking,
You look
you're gonna
elsewhere.
you're
Yeah,
gonna start selling them, right?
yeah.
So if you don't continue to make new highs, yeah, people will start to get the idea that, well, maybe these things aren't worth the risk, right? And as you know, everybody's in. everybody's in the pool. Everybody and their grandmother and their taxi cab drivers owns stocks these days, right? Um, so there's to me there's really just a one way a way that the market can go without further actual liquidity, and that doesn't mean the Fed following the market down, right? It means leading the market down. Um, and so, but it doesn't have the you call the pretext to do that, does it? I mean, how if they're going to say that the economy is so strong, why would they need to do a QE, right? Why would they need to push interest rates below neutral, as they call it, if they want to call it that, wherever the fuck that is?
Yeah, well, they have zero. I mean, according to all their official data, they have no reason to. I mean, they had no reason to make that 50 basis point cut either, though.
But we knew they did because if they didn't, the balance sheet would contract too much. Right?
Yeah, no, that's right.
Right.
So going back to that other question I had, though, has this unrelenting stock market bull been the how with the Fed and its goals, how would they view that? Is this a problem to them? Was this unexpected to them? Are they happy that it's ha occurring, or is this kind of put them in a weird spot now? Because as you say, that stocks got to keep going up, but they don't really have any way of doing it without causing, restoking inflation or
Yeah. One of the interesting things that changes that occurred after '08 that nobody talks about, nobody but me, is that the way that new money comes into the system now. Before
just
2008,
yeah.
the commercial banks would be the biggest engine of money and credit growth. So they would loan money into existence, right?
Yeah, go to the bank, get a loan, new money
Right,
floods the system.
right. And the Fed's reserve balances grew, you know, but very slowly, maybe 5% a year, less maybe even, but about that. So its reserve balances like in uh I'm going from memory, so I could be a little bit wrong. I think we're in the 40 billion area in the 90s. And that's up from like say 10 billion in 1913 or something, right?
Yeah, yeah.
So so over like the course of the whole century, the increase in the Fed's balance sheet was not even a factor because most of the money that was created before 2008 came in as through the banks, the commercial banks. They would create new loans on top of those reserves, and there you go, right? So after 2008, the way that that money comes into the market is different. It comes in directly through the Fed's purchase in open markets, right? In the Fed funds markets, in the treasury markets, right? In the mortgage-backed securities markets.
So the
So,
commercial banks aren't pyramiding anymore?
well, they are eventually, right? But the Fed acts first. It expands the balance sheet, and then the dealers. So what I'm saying to you is that the stock market's role is increasingly important in as a transmitter of their inflation policy now. Okay. So because it comes in, because the new money comes in through the market system, through the primary dealers and the brokers, and the banks are sort of there, because the banks own some of these brokers and dealers, right? And so they're part of that group, and then they pyramid on that by, some of them may even just buy treasuries to pyramid on that. I think some of the banks have been doing that.
The fact that there can be this deflationary policy and yet you have stock markets making all-time highs, gold making all-time highs, Bitcoin pushing higher. And so it's just like, how is this possible in a deflationary environment? So the stock market has surprised us and where it's gone. And I'm just wondering, has it surprised the Fed?
I think they probably thought it would collapse along the way several times, including when they were dealing with the bank crisis on the West Coast.
Right. Do they want it to collapse?
I don't know the answer to that, Mike. I mean, I've speculated. This doesn't sort of deal with our questioning, but I've speculated that They want to hold it till after the election. But I've also speculated that they won't be able to.
Right. And it
So
kind of puts them in a like the higher the stock market goes, it not necessarily they want it to collapse or crash, but it can't have made their job easier over this past year. You know, like maybe more moderate, just slight growth would have been a bit more ideal scenario for them.
sure,
Uh, because it's kind of putting them in a bind right now. Like you said, everyone's expecting the stock market to keep going up. There's the liquidity is dried out. Like who even knows how it's things have pushed this high? And
sure,
and I think to your point, for them to really take this plane off again and to go to new heights, they're not going to have to just print a little bit of money. Like it's going to be pretty epic. And and that was their whole MO to begin with. You know that they had to rein in inflation. So it seems like I don't know. They it seems like they might be a little bit uneasy about these high stock market valuations themselves.
sure.
So
And well, isn't there also two like two kinds of investors here, I think too. I think there's kind of investor who realizes that, I mean, that zero interest rate policy was an abnormal um, crisis era monetary regime. Um, and so, in order to have interest rates low like that, you have to have a crisis,
yeah, no, for
right?
sure, for sure.
And
And
then
you
there's
have
the
to be
other.
older. You have to be in the markets for more than a decade to see any
Right.
different, right?
Well, maybe that's the thing. And maybe anybody who's been in the market only since 2008 just really thinks that those low interest rates were just normal.
Yeah, that
And
is the normal. That is the neutral rate.
right, right, right. So, that's the delusion. That's the part that are deluded. But they've been rewarded by the Fed's policy. They bought every dip.
Yeah,
They've been rewarded for buying it, and they've been punished for selling,
yeah.
especially if they sell in fear. So um, the market, the way the market is set up is that they don't really need to pump in a lot of new fresh liquidity because they've got people already scared to sell.
Yeah, I think that's an important point. Scared to sell.
Yeah.
Well, it kind of goes to like I did want to pick your brain a little bit. There was a little bit of a stock market panic earlier this summer and beginning of August, I believe, right? It kind of looked like, hey, is this it? But that didn't take too long to reverse. And is it because you were just mentioning earlier, everyone and their dog is in, and just like what were those average people thinking, when the market just kept going down? Because it's like it didn't seem to panic them enough to sell their positions. It didn't panic the boomer to get out of his retirement portfolio and move it to cash. That didn't seem to happen. Is that because they it's more like you're saying it, this is a dip, we got to buy this dip, like we're gonna be rewarded if we stay in, we should either buy the dip or don't get out.
in part, but I also think it was just the first crack. It was like these things, they just not the first crack necessarily, maybe the first crack already happened before that, but what I noticed was a shift this summer in earnings expectations, should we call them? Um,
Yeah,
maybe they
forward
haven't shown
estimates.
up, maybe they haven't shown up in the formal estimates yet or not. I don't know. But it just seemed like some of the favorites in the market started to disappoint investors in their earnings calls um, this summer. And I know that since then, the crack, um, the hype has been to that the narrow market advance that we saw this past year or whatever is going to broaden out and roll into the other or roll into other sectors. So when you see the Nasdaq and the Mag 7 having struggling with making new highs now, um, and you see the Dow Jones Industrial Average being the leader again, that gives that view some credence. So there's the rotation theory that has played out. Um, and to be sure, when that happened, I I think we weren't expecting this to be the panic. I think we were still expecting this was the first stage of the coming panic, the first step. Um,
No, for sure. For me personally, I was just kind of surprised at how quickly it kind of fizzled out and then just back on course.
were you? Yeah.
Yeah. Yeah.
Shit, Mike. I mean, we've all but said it in our metaphor. The plane may be. I don't think they've landed, to be honest. I think they're still coming in pretty fast, and um, and so I think that has yet to be really sort of proven to me that they've actually landed the plane. But I do think that they have to unload everybody and definitely take out the baggage before and throw out the baggage before they can get the plane off and going again. Um, and in our metaphor, that baggage is the malinvestment, right?
Yeah.
Um, you can't have if you've got an economy that's fully employed um, and malinvested, then it's going to be a low productive growth phase, right? If they get any growth at all out of that. Um, and I don't see how, without further interventions from the Fed, without the Fed reflating, I can't see how they could even keep it up here, even just simply by trying to manage expectations or psychology. It's just a matter of time before people start to get the idea, well, it's just not worth the risk to own these stocks. Um, you know, 3 years go by, maybe I'm down 15% after 3 years, you know.
Yeah. There's better investments for sure.
Yeah, right.
Is that what you're expecting though? Just a long
No,
drawn out bear, or you
no.
expect a panic?
Well, no, I expect a panic because I've never seen such a, a quick shift um, from giving the patient so much heroin
Hmm.
for 15 years and then pulling out and the patient not having a convulsion, right? Like, I mean, I'm sure that I don't know, I've never run a recovery center, or a rehab center. I'm sure there's some instances like that. I don't know,
Like a
but
placebo effect or something. The patient still thinks it's getting the heroin, and it's like at some point it's going to realize it's not.
that's a very good metaphor. I like that. The
Yeah.
market's continuing off on a placebo effect. Because everybody's telling these investors that the Fed's still printing when it's not.
Well,
Imagine if
most
they
people
actually,
still think that. Most people think that whether they look into it or not.
well, maybe that's it. I mean, maybe it's just that people haven't realized that the Fed is deflating, that they've decided to stick it out. I don't know. I doubt that. I doubt that. I doubt that. I doubt they would know what that meant, um, and to be able to execute a decision on that. They would anybody who believes us that the Fed is deflating just automatically assumes what we do, what we know too, is that they're going to it's temporary, that
Yeah.
the
Yeah.
deflation policy is transitory, it's temporary. We know that.
Yeah.
That's why they're really having all the hard time with sticky inflation, and that's probably at core behind why the stock market hasn't come down, right? They've continued to sterilize this deflation policy, first with promises of rate cuts.
Yeah.
If they can keep the inflation situation moderate and the market not selling off, um, trying to think of a scenario where they could transition, it would still take time to squeeze out the inflation expectations the way they are, for people to stop thinking about the Fed being an inflationary printing machine.
Yeah.
Um, it would still take time for that. And I just can't see the boom lasting throughout that time. without having to reallocate the capital and labor that's diverted to projects that should be uneconomic at these interest rate levels.
No, exactly. Yeah. I gotta unload that baggage, right?
The bottom line is you have this stock market that's been in a bull cycle, major bull cycle since 2008. If you want to ignore the mini bear markets in between, um, because they never lasted longer than a year, right? If you want to look at that whole bull market cycle, man, the market just didn't have the right navigation equipment to make the I should say the economy didn't have the right navigation equipment to make the right decisions about where to invest capital and labor. I mean, you have, but that aside, putting that aside, you've had the longest stretch in history where you've addicted the investing public to fresh money coming off the printing press. And then all of a sudden you stop printing. And so that's the main premise for my call, right? That combined with the fact that all the metrics are stretched historically, the valuation, sentiment, all the stuff, all fucking stretched, right? Um, and no doubt about it, uh, the Bears have lost credibility in making the bearish calls,
Yeah.
and that includes me too. Um, but how the market works. That's how it conditions investors. Before the top comes, the bull has devoured a lot of the bears, and I'm trying to be careful in not being overly bearish in that 80% of our portfolio is still um, outside of the this of betting on the bull market to roll over. But the I was going to say in the very beginning when we were talking is that the timing of this is it's important because we want to keep our costs minimum, and shorting the market is a hedge for me. So I want to keep our costs from exploding too much on a hedge. So timing is important, but the most important part of this call um, is not so much the panic stage. Although I think a traditional bear market in stocks could last 1 to 2, 3 years and have several panics, right? And I foresee that happening, but the panics are one thing when you got to deal with them in other markets because they impact other markets. Um, but the most important thing to our whole story about the stock market rolling over is that the stock market is, like I said, is become the main transmission mechanism for the Fed, and so it's a very much of a more of a leading indicator for the economy than it ever was. And a rollover in the stock market um, is where is going to set the stage for several dominoes that will eventually lead to the central bank, the Fed, changing its policy to something accommodative, right?
Right.
So that's important for our fundamental story being long gold, silver, crypto, the anti-dollar trade.
Yeah.
Or if the Fed says, okay, we're just going to not do anything this time and let the malinvestment liquidate, like these geniuses say,
Yeah.
right? Let the recession run its course by itself, right? We're not going to step in at all, right? Then in our case for gold, crypto weakens.
Yeah. No, for sure.
Okay.
Yeah.
Um, so the for and uh we're only in the first or second stage of the bull market in those things. The commodity market reversed in 2020 from a bear market. I think it was a 10-year long bear market, actually, almost for most commodities. It reversed, but we haven't made the transition yet from a bull market in financial things, stocks, bonds, and so on, to a bull market in hard assets again, right? These are counter-cyclical things. These happen when the other doesn't happen. And so we need the stock market washout to set the stage for the next steps, which are the Fed panics, the Fed reflates, the dollar goes on to another bear market, and we get a huge commodity asset cycle.
Yeah.
And every time it undergoes that, it gets closer and closer to the final crack up for the dollar system, right? But that's the cyclical thing that we need to see. Those are the steps we need to see. So if the stock market keeps going up, if they somehow pull a rabbit out of their hat and the inflation rate falls and the stock market keeps going up without them having to inflate, then gold and silver will fall and the US dollar will strengthen. Okay? But right now, they're all going up together because they're all making the same bet together, that those rates are coming down more
Yeah.
and the Fed's going to reflate.
Without a panic first.
Right. They may be able to keep extending it day by day. They may be able to extend it to the after the election, but it's so overdue. I'm amazed and again, my conclusion is they've got everybody scared to sell. That's the bottom line.
It seems like they're trying to delay the inevitable. And you make the argument they probably know that the inevitable is coming too. And so I just get caught up. I just keep asking the question, well, what's to their advantage by just stretching it out longer and longer? Because it seems like the longer they delay this, the worse it's going to be. And if they know that that's coming, then why do they keep doing this? And I don't know if you have an answer, but the only answer that I can seem to come up with is that they're hoping, or maybe they know, or maybe they're hoping for some sort of outside event, like a world war or something, or a COVID 2.0. They're hoping for some sort of outside event to panic the markets so that when they do reinflate, there is no blame being placed on them. Because if the stock markets were to crash right now without some sort of an outside event, just for all the reasons you just said, there's certainly going to be some fingers being pointed at the Fed for fucking it up. And
And
it
not
seems
just
like,
the Fed,
yeah,
not just the Fed. Could it be that they want to extend this boom because they don't want Trump to win?
yeah, I think that there's a part of that. You could speculate a lot of different reasons for why they're delaying it, but it's just that it's just a delay,
Yeah.
and so that they can have control over the narrative or point the finger away from who the finger should be pointed at.
Yeah. But if you ask me why they're delaying it,
Yeah,
the my answer is because they want the status quo. They don't want Trump to come in. And if the markets crash now, people would blame the current administration, and Trump would make all sorts of promises
yeah,
that would boost the market,
yeah,
right? And so then Trump would get elected
yeah,
if the crash happened before the election. If it happens after the election, if Trump is in, they can blame Trump.
exactly.
If it crashes after the election is in and Kamala's in, then nobody will care. Right? It was overdue.
I just think they don't want the Fed to be blamed. They don't want people to question the legitimacy of central banking. That all needs
Sure.
that needs to keep intact. I think to me that's seems the aim. That seems the goal. It's not to keep the stock market inflated. It's not to make a soft landing. It's to avoid blame
Yeah,
and continue their own existence.
there's definitely truth to that. It's part of their ability to continue. If they're going to have blame, if the finger's pointed at them, and then they come out and say, "Well, we're going to reflate now."
No, if anything, they want the exact opposite situation. They want something that wasn't them, and then the markets and investors and the average person is begging, do something. Why won't they do something?
Right.
Like, okay,
That's
you
it.
told us to.
That's the playbook. You got it.
Yeah.
So where's your conviction? Is your conviction where's mine, or are you less or more? Or
Me personally, I'm 100% convicted. There's nothing. The only thing that bounces in my mind is the timing.
Hmm.
I'm not as confident as you that they can't stretch us out for another year or two or three or four. Like I don't fucking know. It's boggles my mind that they've been able to stretch it out this far.
Yeah.
It seems to me that there's something I'm missing, but I don't think what I'm missing is that the Austrian business cycle is wrong. You know,
Yeah.
like you know what I mean? That's not it. So what is it? And I think
Well, but when you think they can stretch it out one, two, three, four, five, are you thinking without intervening at all?
no, I'm saying I'm not sure what's going to happen. I like
Yeah.
I don't know what tricks they're going to pull out of their
Like, can you
sleeves.
imagine them being able to, without intervening,
Yeah.
without changing monetary policy, without inflating,
hmm
could they keep this going for one, two, three, four, 5 years?
Well, 4 or 5
How?
years seems like a stretch, but I just kind of go month to month, maybe even a year. Just the same phenomenon that we've already seen. That the market is naturally bringing down the rates because of all the rhetoric. That the Fed keeps making just managing expectations. The data, whether it's slightly fudged or completely fabricated, it keeps supporting the soft landing narrative. And they're all talking gradualism now. It's like they made their cut, they got it done with, and now it's like, well, maybe we'll cut again, maybe we won't, maybe we'll do a 25 basis point, and then maybe there'll be a pause. It's just like, and it's just like as long as everyone like I one thing that I'm very much convicted on in a bunch of different areas is it really feels like most people think that good times are just around the corner. Nobody's
Yeah.
expecting a recession is just around the corner. And so as long as that psychology can be maintained, I think we can stay afloat in la la land here for a little bit longer. Not permanently. I don't know about 4 or 5 years. I'd be absolutely shocked if it was that. I'd be shocked if it was, in 2 more months. I'm shocked that we're at this point in time.
Yeah.
But it's not because
But where
the
would they
reason
get
I the
the,
reason
where?
I'm shocked is because of my conviction. Because I don't think there's any holes in the argument.
So where would they get the money from? Where would new investment come from to drive to keep rewarding investors
Where
for
has current
staying?
investment come from? Like we
Well,
weren't
right
expecting
now,
this, right? Like
well, a lot of
we could have had this similar call 3 or 4 months ago and said, listen, there's
no,
no
but
more
a
liquidity.
lot of what's happened over the last year, I can tell you where it's come from. It's cannibalized. So it's basically from the broader market to narrower market. That's for the last year, right?
Okay, so let's keep doing that. Just keep
Now
playing
they're
that.
trying. Now they're trying to broaden that out, but
Yeah.
there's no liquidity coming in to support that move.
Yeah.
So now, apparently, I mean, for the last year and a half, from the 2002 22 lows, okay, you've seen only half the less than half the commodity markets rally, um, less than half of the stock market rally,
Yeah.
right?
And crypto's the
So,
same way. It's just basically been
right,
Bitcoin, right?
right. Bitcoin dominance keeps growing and growing,
Yeah.
right? Well, that's because of this fact that there's no fresh liquidity coming in, so there's a little bit of cannibalization,
Yeah.
you know. There could be some new savings coming in a little bit here and there, and there could be some rotation. Um, the rotation explains some of the things. Um, the broadening has to be uh, ephemeral. It could be part of the result of a drop in interest rates. Maybe some money is leaked out of the money market funds without putting pressure on interest rates there, just because of the drop in interest rates. So, maybe you could have that, right? Um,
But I'm with you. It seems like
I
we're at
know.
the end of we're at the end of the line, but like
I'm
there could
just,
be a little bit more in that line. A
yeah.
little bit more a little bit more juice to squeeze out of that rock. You know what I mean? I
Yeah,
don't know.
sure there could, but see, that's the thing, right? Though, is if you waited till they squeezed out every little bit of juice out of that line over the last 100 and something years, you would have always missed your shorts.
No, exactly.
You
Yeah.
you would have never been right. You would have always been long until it was too late.
Yeah.
Right?
I think
Um,
that's the wisdom here. And I mean, that's personally why I'm short right now.
right.
Even though I'm saying to myself, fuck, can they make this go another 6 months? Maybe. Fuck, I don't know.
I can just tell you that from past experience, it always feels this way, at the top. And so it's it's par for the course in a sense. It's supposed to make you feel this way. You're supposed
Yeah.
to not be sure. If you're sure of yourself, then maybe it's not the right call, right?
Yeah, no, I'm with you. It's another part of my buy-in to all this. Or even just like in our last video, I think it was our last video, is on soft landings. There's such a prevalence of soft landing calls or claiming success. I mean, if you look historically, that the times when this happens is right before a
Yeah.
collapse, right before a panic. So yeah, I think there's
Yeah.
definitely a lot of celebration too early here. Um,
Well, one thing also is pretty, you could make the case that the market has priced in, it's definitely priced in a soft landing and it's priced in a takeoff,
yeah,
accelerated takeoff, right? Um, so if that's true and the soft landing guys are making the right call, then things should not get worse. So any evidence or any data points that say, oh, this is getting worse, that should undermine the market, right? Because the market is priced for the worst case scenarios way behind us.
yeah. No, I'm with you. Just thinking this out top of my head. So because it's been this kind of a game though, right? So we're in a situation right now where I'm kind of going with what you're saying because I agree. If bad economic data starts coming out, you know, it would kind of suggest that the soft landing has not been a success, right? But I know how the media will spin it. They'll be like, "Oh, jumbo rate cut coming." They're gonna start cutting. It'll save it, and it's just kind of like back to where we were 6 months ago, where everyone's getting excited about rate cuts that haven't happened yet.
Yeah. Well, the
And will
answer to that question,
will that be able to keep the cycle? Will that be able to keep people from panic selling and just staying in, even if there is a slight decline in the stock market?
well, the fact of the matter is that um, when the Fed embarks on rate cutting campaigns, is usually during a bear market in stocks, and it doesn't stop the bear market. It
No.
continues. It plays out. Um, and in those periods, the Fed is fighting the trend for a long time. Um, from the fall of 2007 to the end of 2008, the Fed was cutting rates and the market was collapsing
Yeah.
at the same time, right?
Yeah.
Um, from 2001, from 2000 to 2002, the market was declining and the Fed was cutting rates from 2001 to 2003, right?
Well, I think that maybe the takeaway there is that it's what could do it, what could break the psychology is when the Fed is cutting rates, okay, and the bad economic data starts piling up,
Yeah.
right? And so it's like they've just made this first cut right now, but they're already walking back from it. They're already saying we might pause, or we might not go so aggressively. And so if there is poor economic data, the the people that are buying this whole soft landing thing will say, well, they got to cut rates a little bit
Yeah. Yeah. But the point at which, yeah, that's the whole thing, right? I mean,
more. It's
Mike,
it's a head game. It seems like it's just a giant head game. I think that the rubber will hit the road Okay, they've made a 50 basis points cut, but let's just say, they make another 50 cut and another one and another one. And the whole time that they're making these cuts, economic data is just deteriorating. It's like that to me, I think will be the aha moment where people are like, oh, they're fucked.
Yeah, that could
It's not
happen.
going to
Totally.
matter, but we're not there yet. They've just dipped their toes in the rate cutting pool, and so any poor economic data that comes out soon, unless it's really, really bad, I don't think it's going to panic investors. It's just going to make them think, oh, they're gonna do another jumbo cut. Let's just do a bigger cut. It'll be fine.
Yeah. But if you waited for those moments in the past, you
Mhm.
would have missed some pretty big short opportunities already.
Yeah. No, I'm with you. I'm with you. I don't even think you would have seen
Um,
them.
and in this case, the reason that I mean, I think I was partly already right because 2022 was a bear market, right? But the only reason it didn't continue is they got their little mini banking crisis, and then they shifted their policy to pretending they're going to cut rates forever, right? Again,
Yeah.
um, but um, but really, the reason that I'm making a bear call in the first place is just the sudden shift in monetary policy. You had a bull market. The bull market that we're seeing that it doesn't want to finish today was created on a foundation of inflation and debt. Nothing of real substance, nothing compared to what we saw in the 1920s when they were building cars and airplanes, nothing like the late 19th century where they're building railroads all over the country, nothing like in the 1960s where and 70s where they're bringing in the personal computer, nothing like the 80s or 90s where they're bringing in the internet. Um,
No, I mean, if anything, it's been a real shitty go for the average consumer, right? The inflation has eroded their purchasing power.
right.
They're spending more and getting less and taking on more debt. I mean, that's the reality. But it does seem like all those people, they're not taking on all this debt expecting a panic or a crash around the corner. They're taking all this debt and going fully into the stock market because they think good times are coming.
Well, but they're already in. See, so and the Fed's policy is not to now allow that debt to increase in aggregate.
Yeah.
So there's no fuel for the stock market as far as I see. That's the case. I'm not making the case for a end of the world collapse in stocks and bonds and I mean we're on that path, right? But that's not the call I'm making here. I'm
No.
making just a typical cyclical call based on the boom bust cycle and the causes of the boom bust cycle.
Yeah.
My 30 or 40 years of experience and how stock bull markets work. So
No. No, you're not expecting a collapse of society. You're expecting them to reflate, and which will be bullish for all of our anti-dollar positions.
exactly, exactly, exactly. Right.
Only difference is between you and most people is most people are expecting them to reflate, but they're not expecting that they're not accepting that there needs to be a panic first.
They're not accepting what I think is going to happen before the reflation. That's gonna take to get the Fed to panic in order to reflate, right?
Exactly. Exactly. I think that's the crux of it. Okay, well, that concludes our discussion today. We just wanted to thank everyone for watching. Hopefully, you can see that the case for a market panic is stronger now than it has ever been before. It's not really a question of if, but rather when. And the clock is most certainly ticking. All right, until next time, everyone. Thank you for watching.